How many of you remember this crazy trading experience?
Yes! Yes! Hi!
Well, it's not always an experience to remember, because this kind of particular incident have literally happened to almost every beginner trader, especially when you want to flip your small account to a bigger account and you want to stack it up when trade is on. I was once a victim of this, where I wanted to raise my small portfolio account to bigger account and ended up blowing that account. Reason is because I don't understand the edge around this concept. You see, most traders don't understand the difference between DCA and stacking, okay, and they end up blowing their portfolio account over and over and over and over and again, right? So especially maybe if you're trading ProFirm and you keep on buying multiple ProFirm accounts every now and then, and you keep on blowing it because you don't understand how to actually either DCA or stack the right way. And that's why you need to stick to the end of this video, because at the end of this video I'm going to be sharing with you, all right, the proper edge around these two concepts that can help you to understand how to use it properly, applying the proper risk management. Because at the end of it, if you don't know how to use proper risk management, why applying this strategy? Okay, either you're stacking or you're DCAing, all right, so you end up blowing your account. So if you don't want to end up like this, okay, make sure you stick to the end of this video so you can be able to trade profitably like this when you have already mastered this particular concept on how to stack or DCA, right? So in case this is your first time of coming across my channel, my name is Cyril. So do well to like this video, subscribe to this channel. If you're getting value while this tutorial is on, do well to comment your opinion below. Ask your questions. I'm always available to answer your question. Also turn on the notification bell so that you're getting more updates as I drop it, right? So right now I'm going to be going to my chart. Let me first of all explain what this whole concept is all about through illustration. Okay, so that's it. So let's head over to our chart right now. So on our chart right here, right, so we have DCA strategy, we have stacking strategy, right? So first of all, what is DCA? What is DCA? DCA simply means dollar cost averaging, and most crypto traders do use this DCA, okay, so to actually trade. Okay, they use DCA strategy to actually they use it around their trading strategy or whatever, right? But the truth is that this DCA strategy or stacking strategy can help you to make most out of the market. It can also help you to run that portfolio to zero, right? So DCA simply means dollar cost averaging. Dollar cost averaging. So in this scenario, we're going to be discussing on the buy section, like, all right, so on the buy section, this is what we are going to be discussing here. So after this one, we are going to head over to the sell section, right? So here, DCA strategy means you buying at a cheaper rate. You want to actually buy an asset, okay? You want to actually buy at a cheaper rate so that when it goes up, when we have the major move to the upside, you now be able to sell, making massive profit, right? On the other hand, stacking, you want to actually buy when the price is going up. You don't want to buy cheaper. Like, it's not as if you don't want to buy cheaper, but it's not at a particular point where you start to buy, you continue to buy. No, you want to buy once there's a move up, you retrace, you buy, a move up, you retrace, you buy. But this here simply means you buy when it dip the more. You buy when it dip the more. So when it goes up, you make profit. First of all, let's discuss this here strategy right here, right? So as you can see, let's say this is your chart right here, and this is this pattern you want, this spot you actually want to enter the trade. You want to enter the trade here, right? So here right now, you actually buy at this spot, right? Now, when the market go up and comes down again, which means the market dips, right? You buy again, right? So upon the dipping of the market, or upon the coming down of that particular price of that pair or the asset, you want to be adding more position. You want to be buying more and more. So, and the more it dips, the more you are buying cheaper. The more it dips, the more you are buying at a cheaper rate. So as you can see, until it gets to a point where you no longer want to buy more, and you now hold on to see what the price will do in the next couple of hours, minutes, or months, I don't know, or weeks. So as you can see, once the price starts to go up, you are going to be making massive profit, because this particular last spot in which you actually purchase, right, will be making you massive profit. So as the market goes up, you made profit. So this one, at this point, you actually bought or buy for, right? It goes up, you make massive profit again. It goes up again, you make massive profit again. It goes up again, you make massive profit again. So at this particular, the last spot in which you buy, we carry the most major profit. These ones follows, right? So until now, you now hit maybe your take profit, okay, or maybe at a point in which you want to say, okay, you are satisfied with the profit you've made already, and you can now exit the market manually without hitting your full take profit. But trust me, this strategy can help you make the most out of the market if you understand how to do it and do it the right way, right? So this is DCA strategy, okay? So on the other hand, this is stacking strategy, right? Stacking is different to DCA, right? But a little bit similarity, because this is where you normally buy, right? So stacking strategy simply means you don't want to buy when it dips the more, okay? You don't want to buy when it dips the more, right? So how do you do it this way? So let's say this is the point at this support level or demand level. This is point which you actually start to buy, right? Let's say the market, this is your entry point, your first entry point, and you buy here. So as the market goes up, right? As the market goes up, remember, you want to add another position, but you want to see that you are already making small profits. Now, when the market retraces back, right? This is when you want to add another position, right? You want to add another position when the market retraces back. So this is the best video you ever see online. This is the best video. This is the best tutorial video on stacking and DCA you ever see online. So make sure you continue watching this video to the very, very end, right? So when the market now dips more, you buy, right? So it goes up, retrace, right? Which is deep small, you add position, right? This is by 3. Remember where you started to stack. You started from here at your first entry point, so where you buy, right? So when the market move up and retraces, giving you the red candle at every closure of the red candle, because the market is going up, so you want to be buying. So every closure of every red candle, when the market moves up, right? Every closure of every candle that retraces back, you want to add position, right? So in that way, the first buying or the first position you actually had, right, is already making you profit. It's already making you profit. In that way, it is very, very impossible to actually blow your account, because you're already making profit and the market is going up, right? So as you can see, you add more position upon retracement or the end of every closure, the closure of every red candle, right? You add position here, right? It goes up. You add position here, right? It goes up. So in this way, this particular last spot is the one that is making you the most profit right here. Now you are now using the profit this one made to add another position, right? You're not using your own money. You are using the money the market already given to you, the profit the market already given to you. That is where you are using to add another position. It's not as if you are using your own money, right? Now, as it retraces, you add another position. This one, once this one, you add another position here. This one goes up again. Use this profit this one made to add another position upon retracement. As it goes up, this is how you are going to be doing it until you reach to your potential peak profit level, right? Which might be at this supply level, right? So as simple as that. But on DCA strategy, so once you buy here, it dips, you are making loss, right? But the major aim here is for you to be buying cheaper. So upon dipping, you are buying, and the first position you've added, right, is already on loss already, right? But this is where it gets more interesting, because this is where risk management now can come to play, right? If you don't understand how to manage your risk here, if you don't understand how to properly manage your risk here, you end up blowing your portfolio account. In fact, you end up losing all the time, right? Now, how do you actually apply proper risk management here? This is where I'm going to crack it, right? So here, let's say you have $100. You want to trade, right? You have $100. And mind you, this DCA strategy, basically crypto traders use it on spot trading, okay, and also use it on futures trading. Now, DCA strategy and stacking can be used in Forex, okay, Forex trading. Yes, it can be used across all markets, and you can use it across all time frame, right? So let's say you have $100 you want to risk out here, right? You actually want to risk $100 right here, right? So let's say this is $100 capital. This is your $100 capital, right? So this $100 capital right here. So I think I'm having network issues. let's reconnect. Okay, so let's say you have $100 capital right here, right? $100. This is your $100, right? So good. This is your $100 capital. Okay, now this $100 capital is the money you want to use to trade. You don't have this $100 capital, right? It's not as if it's your whole of your capital. Like the whole of your portfolio account is maybe $10 or $1,000. Let's use $1,000. The whole of your portfolio account is $1,000. Okay, or $10,000, maybe $10,000. You want to use 1% of $10,000 to trade, right? You want to actually risk 1% of $10,000, which is what? $100, right? But then this $100, you also want to, okay, apply risk management on this $100. Yes, while trying to trade using DCA strategy, right? Either you are buying an asset or you're trading futures or Forex, right? Or stock, anyone. Now this $100, now you now enter. What you need to do here is to divide this $100 into what? Into 5. Divide into 5. If you divide this $100 into 5, it's going to be giving you $20 each. $20 each. Now this market here, remember this DCA strategy mostly work well with spot trading and cryptocurrency, right? So, but also you can also apply it on futures and rest of the Forex stuff, right? Now this $100 divide into 5. So once you divide it to 5, you'll be risking $20 upon each position you buy. Upon each position, let's say position 1, this buy 1, you buy with $20 right here. You already know that in your mind what you want to risk at is $100, right? So by 1 you risk $20, right? Now you wait until it goes more down, you put another $20, right? So it goes more down, you add another position of $20, it dip more down, you add another position of $20. This is how you are going to be doing it until that $100 is exhausted, like dot finish, right? So you know that this your trade, this whole position here is carrying $100 risk. You understand? So you don't want to buy with $100 here from your portfolio account. You buy with $100 here and it dips more. You add another $100 here, it dips more. You add another $100. No, this can potentially, send you to your village. Who knows? Or maybe blow all your portfolio account. You start struggling again to raise another capital, right? No, map out the risk you want to risk out and apply risk management by dividing that 1% risk into how many times you want to stack up, right? Like you want to DCA, right? Not stacking, you want to DCA. So divide it 5 times. Unless you want to add 5 positions, you want to buy 5 times. Divide $100 by 5. Add first position $20. When it dips more, add another one. When it dips again, add another one. That is by 3. Upon dipping to the another downwards, you add another position, and that's how you are going to. At the end of the day, you have 5 positions open, and these 5 positions open have nothing less than $20 each, altogether $100. So when this market start to go up, you see that you are going to be making massive profit here. You are going to be making massive profit. These $100 you can literally feed this $100 to $1,000. It's possible, yes, it's possible. You can literally feed this $100 to up to $2,000 because you understand how to apply this strategy. This is very, very important, right? So on the other hand, this is stacking strategy. Let's say $100 is your 1% risk out of your $10,000 account, which is your portfolio account, right? And you want to risk $100. You want to trade futures, crypto. You want to trade Forex, stock. You want to trade binary. So you want to actually risk 1% of your $10,000 account. Mind you, across all sides of portfolio account, whatever you want to risk out, this is when you apply this, right? So let's say I'm using $10,000 account. I'm risking 1%, which is $100. Let's say you want to start trading with this $100. What do you do here, right? You enter with this whole of this $100 because this is your risk. Once you have done your analysis, okay, you want to risk $100. You don't need to divide this $100 into 5. You actually, what you need to do here is to enter with this whole of this $100. Enter the whole of this $100 at this spot, at this demand level, right? Now, once you enter at this demand level, what you need to do right now, do not add any other position. Do not add any other position. Allow the markets to make a move to the upside. Okay. Now, after the market have made a move to the upside, you're already making profit. At least you're already making at least $20 or $50 profits. Okay, as case may be, sometimes you're already making maybe $50 or $20 profit, right? So what you need to do now is to look out for another spot to buy. So where is another spot to buy when the market retraces back to give you the closure of the red candlestick? Every closure of the red candlestick, this is where you add another position using the profit you already made. Okay, you add another position using the profit you already made, right? So let's say this goes up, it traces back, you add another position here, right? Maybe you're making 1:1, maybe you're making $100 already, which is 1:1, and the market retraces, you add another position with $100, right? So this one is already making you profit. The profit you used to add another position, it goes up again, you add another position, it goes up again, you add another position. Every profit, every position is making for you, use it to add another position, right? So upon going up, you are going to making profit in that particular current position. Hence the market is going up, right? Hence the market is going up. And mind you, this particular first buying position here is going to be making you huge amount of profit, right? So you're adding more until it gets to your take profit level. And this is how to kill the market, right? Using these simple basics of understanding how to use DCA strategy or stacking strategy. Very important. And this risk management is very important. So let's go to what? Let's go to the sell side. Let's go to the sell side. Let's see how to actually also apply it on the sell side, right? So this is the sell side, right? This is the sell side. This is the sell side. Okay, so as you can see on the sell side, just divide the $100 into what? Into 5. When you want to DCA, okay, when you want to buy cheaper as the coin is going up or as the asset is going up in price, you want to buy cheaper, right? So now you want to be selling, not buy. You want to be selling. Let's put this like this. Okay, $100. This is $100, right? You want to risk this $100 on this part on a particular trade, right? And you want to use this here strategy. Divide the $100 into 5, right? Now what you want to do is that this particular sell side or sell strategy, when it comes to DCA, don't really work with spot trading. If you are trading crypto, it doesn't really work that. Like you don't apply it, okay, when it comes to sell. Okay, because now you are selling, but when it comes to the futures market, you can apply this when it comes to futures, because you sell to make profit, you also buy to make profit, right? But spot, you only buy when it goes up, you make your profit. So when it comes to futures, or maybe when it comes to Forex or binary stock, so you want to apply the same thing, divide this $100 into 5. So let's say you enter a sell position here, right, with $20. You enter a sell position with $20. So it moves up, right? You enter another position with $20. It moves up again. Upon the closure of every green candle, every bullish candle, you add another position. Upon the closure of every green candle, you add another position, right? So here you are already making some losses here because you entered $20. You're already making some losses, but your stop loss must be above, right? It must be above the final buy position you want to buy. Your stop loss must be above it, right? So you buy here, it goes up again, you add another $20 position, it goes up until it gets to that point where you no longer wish to buy. And maybe that point is where, according to your analysis, where the market will start to drop. Now when the market starts to drop like this, you're already making massive profit. The last point in which you buy carries most of the profit. Yes, it carries most of the profit, and that's why you cover this, and finally hit your full take profit. So let's say for stacking here, you don't need to divide this $100 again. You just use the whole of this $100 because it's a 1% discount of your whole portfolio. You want to use it to enter a sell trade or a sell position here. Okay, all of it. You want to use it to enter here. So once the market starts to come down like this, market came down and retraces upon the closure of every green candlestick. Okay, upon the closure of every green candlestick, this is where you add another position. Okay, because this first position you've added here, the market have already dropped a little bit, making you profit. Maybe $1:100 profit. You use that $100 to add another position again, sell 2. It drops again. Use that profit again to add another position again, sell 3. So at the end of it, you realize that you are going to be making massive profit right here when you want to stack or when you want to DCA. I hope this video actually makes sense to you, right? So let's go to the chart. Let's see a proper example of what we just illustrate in this particular chart. Let's go to our chart right now. Let's see. So as you can see, this is our chart and this is BTC USDT. I'm going to be using BTC USDT, right? So I'm going to delete all this stuff so that we will not get confused, right? So let me delete all this stuff, right? This is 15 minutes time frame. Like I said, it works across all time frame and across all markets, forex, crypto, stock, binary, whatever, right? Now let's say you after your analysis you have analyzed and you enter the market here, right? This is for what? This is for I'm going to use here for I'm going to use here for stacking, right? So this is your first position. You actually buy from here. Let's say you lose $100 here. This is for stacking, right? You lose $100 here. So you don't want to add another position here again. So allow the market to move up. So once the market moves up like this and retraces upon the closure of this red candle, you add another position because you're already making profit here already. So you add another position, protecting this capital, protecting here, okay? Because you already made profit. You don't want to add multiple positions around this zone, okay? So when the market maybe eventually come down, you risk more than you are willing to lose, like, and that's we want you losing more than you can take. Okay, all right. So you don't want to add multiple positions here. So you want to add position when you've seen that the market have already made that move and it traces closes with the red candle, and you add another position with the profit the first position already made for you. All right. Now the market moves up again, you add another position upon retracement. So the market moves up again, you add another position. So that way you are making profit already. Okay, until maybe this is your take profit. Around this zone is your take profit. Okay, so around this zone is your take profit. Let's say you enter the market from here, right, and put your stop loss below the high, right, below the high, and take profit here, giving you what? 2:1. So this 2:1, if to say, like, let's say you risk $100 on this trade, you're going to make like $200 because this is 2:1, right? But then because you are using this stacking strategy, you can make more than $200. Why? Because you stack more position than one, right? Because upon retracement you add, and that's how the market is going to be moving up at the hit of full take profit. You're literally going to make more than $500 on this trade, right? So that's it. So on the other hand, for sell position, the same stacking, right? For sales position, the same stacking, right? For sell position, the same stacking. So what happened here is this. So as you can see, let's say this is your entry, right? Let's say here is your entry, right? Here is your entry. Okay, now this is your entry right here. The market now you come back, retraces here, you add another position upon the closure of the red candle, right? So this is your first entry. This spot is your first entry. Let me map it out. Okay, this is your first entry, right? So here is your second entry, and the market now moves down, retraces and closes with what? This is sell side on stacking, right? And closes on the green candle. You add another position here, as you can see. Now what happened again? The market drop and retraces again. You want to add another position here again. All right, you add another position here. Okay, so what again? The market now came back again, like drop again, retraces, you add another position here, right? Remember, your initial risk in this particular stacking trade is $100, right? Hence you want to start. Your initial risk is $100, but you have used that $100 you have took advantage of the $100 according to the profit the market have already given to you to add multiple position, okay, helping you to make more than you want to earn in the market. Okay, your potential profit, making more than your potential profit. You add 1, 2, 3, 4, 5 position. Now let's say this is where you short the market. Okay, put your stop loss above the high. Okay, above the high. This is your stop loss above the high, right? Now your take profit at this level, at this demand level, right here, right? Now what happened? The risk to reward ratio here is almost 6, right? Almost 6 risk to reward, right? If you are risking $100 on this trade, you are literally making like $500 or $600 about 500 plus, okay, on this particular trade. If you only risk $100, if you don't add any position, right, you're actually making $600 or $500 on this trade. But because you stack up multiple positions, you see that the potential, the potentiality of you making at least $2,000 is possible. It's possible because you are adding multiple positions upon every profit you're making on the retracement of the price of the market. Okay, you add more position, one position, and also you have like five different positions. Each of them made you profit and hit your full take profit. So this is for stacking, right? Now let's go to what DCA. DCA works well with crypto spot trading because you work for crypto spot trading because of we want to buy, like we are buying to make profit when the price goes up, and also it also works for futures when you want to sell. Okay, so that's it, right? So now let's look at DCA. If you want to buy on DCA, right? Now let's look at it. Okay, so let me look for buying opportunity, and I see buying opportunity, buy. Okay, now let's look at it here. Let's look at it here, right? For DCA, right? Let's say this is where you enter. This is the spot you enter, right? You enter, you actually bought here. Let me delete this. This is your first entry, right? This is your first entry. Okay, your first entry, because let's say your risk here is your risk is 1% of your portfolio. Now you divide that your risk, okay, by 5. Let's say according to how many positions you want to add. Let's say you want to add like 5 positions, like you want to buy at 5 times in the market. You divide it by 5. $100, okay, is gonna give you $20 per position if you divide it by 5, right? So if you have $1,000, you can still divide it with how many. It depends on how many positions you want to add. Just you can do the math by yourself, right? Let's say you want to add first position here because I'm using $100 as the risk. So first position here should be $20. Okay. Now the market now dips more. Okay. When the market dips more, all right. So I'm going to add another position here at this point. I'm going to add another position here, $20, right? So the market now dips more again. I'm going to also add another position here until it gets to this supply level, okay, where I will no longer add more position because, okay, I can also add another position here. This is the 4th one. So how many positions is here, right? I have how many positions? 1, right? 2, 3, 4, 5, which is 5 positions. $20 times 5 is giving me $100. So I will now place my stop loss somewhere here, right? Somewhere here. My stop loss is somewhere below this high, below this low, right? So what happened here? So if the market starts to make that move to the upside, I'm going to be making massive profit. This is what the spot traders use the most, and they make the most out of the market, right? So if the market starts to go up, I'm going to be making massive profit. How? As you can see, the price of the market actually moved up, right? The price of the market actually moved up, and I made massive profit. Right? Like I'm going, if I risk if I risk it out on this particular market, okay, I'm going to make massive profit. Like longing here, but this is not where I started to buy. I started to buy here, right? So I'm going to make massive profit, right? I'm going to make massive profit, take profit level. And the last position I actually added is the one that is gonna carry the most of the profits. Okay, so this is it. Now for the sell position, is the same thing. So you just look out for a selling market, okay, and start adding position upon every for sell position on DCA, right? So you want to sell, okay, and you want to apply DCA strategy in your selling position, right? Let's say after analysis, okay, analysis is giving you to sell at this supply level, right? This is where analysis is giving you to sell, and probably you now place your sell position to right here. You want to sell from here and you put your stop loss above this high, okay, above this particular high right here, this high right here. So right now this is your entry and this is your stop loss above the high. Right now, what happened? Okay, your take profit should be somewhere maybe around here. Okay, giving you 2:1, right? At 2:1 profit. Now what happened is this. Okay, what happened is this. Let's say you actually sold here. This is your entry. This is your first entry, $20, right? You sold here, and remaining $80. The market went up again. You sold again. Add another $20 position right here. So the market now went up again after retracement. Upon the closure of every green red candle, the closure of every red candle, you sell, right? So you sold again. The green candle, closure of every green candle, right? Okay, you sell from here. Okay, so and the market now went up again, goes up again. Like the market goes up again, you add another position here. This is the last position. Okay, you can still add another position here at the middle. Okay, that's so, which means $20 times 5, that is 5 times, which is $100, right? And you literally risk $100 on this trade, adding one position, $20 on each position. So what happened right here? So hence the market did not hit your stop loss. Okay, hence the market did not hit your stop loss. All right, so the market start to come down. This last position you have added here will carry the major profit in this particular trade. It's going to carry the major profit, right? Followed by the second to last and the rest of them as follows, right? Let's say you risk $100. You normally risk $100 on this 2:1 trade, right? You're going to make just $200, but because you use this particular strategy, all right, then you are possibly or most likely going to make more than $200, like more than $300 on this particular trade, because you actually purchased at a very cheaper price, right? And hitting your take profit, you are going home with larger profit, right? So this is the end of this video. I hope you actually learned one or two stocks in this particular video. If you do well to hit the like button so that YouTube can push this video as much users as possible, so that a lot of people who are struggling with this kind of concept, they can actually learn from it. Okay, and do well to subscribe to this channel, turn on the notification bell, so that you'll be getting more and more content that's going to help you to become at least a better trader, right? Or other make money niches you can actually explore and make money for yourself. Okay, I'm here to always share with you what is working and what is not working, right? And if you have any question regarding to this particular video, or you have any question on any video you want me to make, drop in the comment section. Share this video to your friends and family. Okay, and if you haven't watched the video on how to actually on how to trade a prophem, okay, crypto prophem, okay, if you're someone who is struggling with funds to trade, okay, you are struggling with funds to trade the crypto market, you can check this video right here. This video is going to put you through on how to get this #1 recommended crypto prophem, and their terms and conditions is very favorable, right? You can get it and start and kickstart and ignite your trading journey, right? So I can't wait to see you on the next video. Bye for now.